Now let's discuss further on the costs that are eligible for capitalization under IAS 16. As discussed in the previous video, all the costs we have divided under three different headings. The first one is the purchase price of the asset. The second one is the any costs that are directly attributable to bring the asset to the present location and the working condition necessary to capable of operating as intended by management. The cost, the initial estimate of the cost for dismantling and removing the item and restoring the site to which it is located. So we call this as decommissioning costs. I think these terminologies are familiar and we have a good grip over these terminology. Now let's make a deep dive into the three segments of costs. Let's discuss about the first element, purchase price, including the import duties and non-refundable taxes, excluding any kind of discounts and rebates. There may be certain circumstances where you pay taxes and you get credit for that. For example, you paid a tax of $100,000 for the purpose of purchase of any PP&E, and this $100,000 will be credited to your tax account, which means it's not a monetary benefit, but you will get a tax credit for $100,000, which you can utilize for payment of some of your taxes. Suppose your tax pay will come out to 400,000, which means you can utilize the available credit with you and pay only the remaining amount to the government, which means sometimes a refundable taxes acts as a tax credit and which can be utilized for the purpose of tax payment, which can be set off against the tax payment in the later stage of your business. Hence, these tax credits are excluded from capitalization. If we do not do this, we will be counting one asset twice. Because we discussed that asset means not only the monetary benefit that you get from the rendering of services or from manufacturing of goods, but also from savings in the cost. But also from the savings in the cost. Hence, all the refundable taxes are excluded from capitalization and the non-refundable tax components are capitalized in the cost of the asset, the property, plant, and equipment. So I gave you this example. Suppose we purchase a property, plant, and equipment for $100,000 and the entity has paid $10,000 in taxes, which means in total we have paid $100,000, which includes 10,000 of taxes. Now, scenario one, the tax is refundable. The tax is refundable. In this case, the entity is not going to capitalize the $10,000. It is not going to capitalize the $10,000. Hence, in this case, the amount that is going to be capitalized is $90,000 instead of $10,000. So the journal entry would be fixed assets account debited, refundable taxes account debited to bank. For fixed assets is 90,000, for refund receivable is 10,000, and the bank outflow will be $100,000. Pretty easy stuff. For scenario 2, it's non-refundable. It's non-refundable. Then in such a case, the entire amount is capitalized. The entire amount is capitalized, which means the amount capitalized is fixed assets account debited $100,000 to bank $100,000. So this completes concept number one. For concept number two, let's understand two important terminology: present location and working condition. So present location invites transportation costs. Transportation cost, which means all the cost that is incurred by the entity to bring the asset, to transport the asset to the desired location, to the intended location by the management, is capitalized. The second point is the working condition, which means the installation charges. The installation charges, the trial runs, all of these costs are capitalized because these form part of the working condition. I want to use this asset on a particular way. All the cost that I'm going to incur to bring the asset into my intention is going to be capitalized under point number two. Now let's move on to point number three. We're not gonna spend more time on point number three because I have a specific video on decommissioning costs. So just understand that the decommissioning cost is basically an estimation which change based on the change of the circumstances. So we book a liability under IAS 37 and an asset under IFRIC 1 and IAS 16. We will discuss that point in very detail in the later course of the section of this video.